All right. Thank you so much, Tom, for joining us for today's guest speaker. We would like to start the recording with the introducing yourself, please.
Sure. My name is Tom Sosnoff, and I am the founder and CEO of Tastytrade. And this is I'm into my fifth decade in this business. Let's put it that way. So I started in the business in 1981. It's 2023. So there you go. Same stuff for many years. So I'm kind of an option junkie, as you would say.
Amazing. I know you sold the company, the TD Ameritrade, or
I sold my last company to TD. I built Thinkorswim,
Thinkorswim, yes.
which was a different platform, which I sold to TD Ameritrade in 2009, which is now TD Ameritrade was bought out by Schwab, so now Schwab owns the Thinkorswim platform. But that was our first. That was about a 10-year project for me, and that was a great company, and now it's Schwab's primary platform. But we've moved on. In 2011, we started to build Tasty, and now we've been on the Tasty mission for 12 years.
Excellent. So Tastytrade, this is something that when I show this video to my students, we'll have a link about Tastytrade. What's the difference between Tastytrade and the previous Thinkorswim?
Well, Tastytrade originally started out as pure. I didn't want to build another brokerage firm at first. I actually wanted to build. I'm kind of like, I think they'd like to call me a serial entrepreneur. I don't even know what that means.
You are.
But I wanted to change financial media. I'd already, thought I did a good job of changing, online trading. So we set out to. I was very disappointed with the state of financial media, which was CNBC, Bloomberg, Reuters, all that kind of stuff. Didn't make any sense to me. I didn't understand why people really cared what other people thought. I thought the more interesting part of media was actually, something that's tradable, practical, actionable. And I'm also kind of a stats freak, a probabilistic freak. So I didn't like the state of, financial media. So we set out to change financial media. Tastytrade became the largest digital financial network in the world in a short period of time, maybe like 5-6 years. And then from that point, we decided to branch out and build another brokerage firm because we wanted to control the technology that we were creating all this content, but we wanted to control the back end of the technology. So we built another platform. Originally, we called it Tastyworks. Now we switched it to Tastytrade. And so Tastytrade now we're probably the fourth or fifth largest online broker in America. We're the second largest option broker and the third largest futures broker, but total, we're like the third or fourth largest broker. And so we built an amazing company, and Tasty's just, we still have our network and we still have our platform. And, the primary differences over what we built at Thinkorswim is just that Tasty is, it's bigger, stronger, faster. It's all high frequency. It's got better technology. It's less bloated. It's just a more modern platform. That's all.
When you say the third largest brokerage, you mean asset under management?
No. We don't. No, brokerage is by trades.
Trades. Oh, I see.
Yeah, trading by asset management. We're not asset gatherers.
We're not.
So like companies like Schwab, Fidelity, they gather customer assets. They have trillions of dollars of customer assets.
7 or 8, yes.
Yeah, we only have billions. We're much, but nobody puts money with us to store money here. We're not a bank, and so people come to us to trade, not to place money.
Right. So usually people, when they make a trade, they focus on fees and commissions. Where do you stand in this? Fees and commissions?
There are no commissions for trading stock anymore. They're free, and options are, every firm is basically the same. They're super low. So there's no more commission wars. Every firm is essentially the exact same, right, within a few pennies of each other. We have some gimmicks, like we cap commissions, which people like, but basically commissions are a non-factor anymore.
Excellent. So I'm sorry, I'm gonna ask another question. How do you monetize them?
We monetize our business 3 ways. So the online brokerage business has three sources of revenue. One is transactional revenue, which is commissions. Second is payment for order flow. And the third is the banking side. That's like money on money. So like credit balances, margin balances, things like that. So those are our only three sources of revenue: commissions, payment for order flow, and banking services.
Excellent, excellent. Okay, so before we finish this chapter with Tastytrade, final question in this: what's the next idea? Where the company is gonna grow? What's your next innovation for this company?
So
what's the next challenge also?
I have a couple of challenges underway right now, and I'm glad you asked the question. So I'm working on three separate projects, and I think you'll like all of these. We've just rolled out a brand new digital wallet, crypto wallet, of which we currently support, moving, obviously transferring cryptocurrencies, but we are about to support the ability to move money in and out of Tasty to fund an account. We're also going to support swaps, DeFi apps and everything like that. So digital wallet, which is basically a global project for us. We've already launched it, and now we're building. We're adding adding a mobile-based version and other things like that. It's called Tasty Crypto. We just reacquired an exchange that we'd sold about a year and a half ago. We built an exchange. There was a market for exchanges at the time, so crypto.com bought it from us, and we sold to them because they paid a good price. But we just bought it back from them because they didn't exactly know what to do with it. So we bought it back for a good price, and we are going to relaunch our own futures exchange. I have some new ideas. I'm going to change the world of futures options, and I have some ideas that I'm going to try to implement over the course of the next 12 months. And then we are also launching a brand new trading app that we've been building for the last year. It's designed for millennials on down. So it's basically for college kids and anybody that's just starting out. It's a brand new app. It's called Bad Trader, and it is designed to teach young people how to speculate. So it supports stock, options, futures, crypto, event-based contracts. It supports everything speculative. It is not designed to be it's designed to teach people how to take risk, how to speculate, and how to make quicker decisions. And it's also a fully hosted app with college kids from all over the world.
Amazing, amazing. Did you say three things? Digital wallet.
Those are the three things I'm working on, in addition to running Tasty.
Wow. When I ask this question to other founders or other companies, usually they barely get one new idea, but you have three.
Well, those are the three things I'm working on. Obviously my main job is to build up, Tasty, and I'm still focused on that, but I wouldn't do this anymore if I couldn't build on fun projects.
Excellent, excellent. Tom, before I go to the other about SVP, Silicon Valley and the Fed, but you are not a normal person. I mean, we hear about Elon Musk, we hear about rest in peace Steve Jobs. So how does people live? What drives you to be innovative and continue hard working? Money, you're rich, you didn't need money. Come on.
No. Yeah, it's a little bit weird. There's something wrong with me. I think there's something wrong with everybody. You just have to figure out what's wrong with you. There's definitely something wrong with me. But I really love the challenges, and I think about it kind of from a legacy standpoint or other things. But I think that I'm most turned on by the challenges in the world of business, and I feel like life is short. I've learned over the last 40 years, life is short, and I feel like I would rather do this than anything else.
Amazing, amazing, and you're doing great with your ideas. All right, I'm gonna turn to now. We get to know you a little bit about your business and the challenges and opportunities for your business. I'm going to ask you a few questions related to my class and to the global economy. The first thing is universities, or at least my classes, we're trying to link between the real world and the academic things. And we find, especially in finance, the gap between the real world and academics is huge. So as such, I give students money, like paper money, to invest. Do you think Tastytrade can support education in a class? How Tastytrade can be as a platform support a class?
I mean, Tastytrade was not designed for, for classrooms. I mean, we obviously, our software is available to anybody, anybody, anywhere. So we don't, anybody can download it. It's free. I think it's an amazing learning tool, but we don't support a paper money version or a virtual version. Not because we don't want to, really because, the amount of, we had to decide, prioritize our resources. We're a dev firm. We build software, and we have to prioritize, how we want to use our resources. And like I just explained to you, like I want to build a brand new app, which I'm doing. That takes developers. I'm building a new exchange that takes developers. We're building a crypto wallet in addition to other crypto functionality. We're building our own blockchain. I mean, all these kind of things, you need developers for everything. I just don't want to, there's so much stuff I want to build that's forward looking, that I'm more focused on the things that we have 2-3 years worth of projects in the queue. I just don't want to take people off of those projects to build something that we already have, just a virtual version of it. Like I'm not, I market through goodwill marketing, through providing tons of content. We provide more content in the world of finance than anybody else in the world. I feel like that's our give back, not a virtual platform. Even though we could do it, I just don't have any extra developers. Our resources are like, we're building so much stuff. I just don't have the resources.
Of course, totally understand. All right, now I'm going to take you to the last stop in the talk, which is about SVP, Silicon Valley Bank, the Federal Reserve, and others. Let me start with the SVP. Tom, we wake up in the morning, we didn't know there's even a bank called SVP, Silicon Valley. And then boom, the bank is falling. And then we didn't know it's a regulation or CEOs taking too much risk, because their contracts say if you take more risk, there's a chance you get more bonus. So what's wrong with us? Why these banks happen? What happened with SVP?
Silicon Valley Bank made really just a couple of classic, I shouldn't say classic. Silicon Valley Bank is suffered from a combination of incompetence, fraud, in my opinion, and just an incredible lack of discipline and know-how. It's as much of just as much a story of pure incompetence than it is of anything else. Silicon Valley Bank had one job to do. They had to manage demand deposits. It's a brain dead business. All you have to do is take in money and not put the principal at risk. And they put the principal at risk. The whole thing makes no sense to me. I mean, I know why they did it. They put principal at risk because interest rates were essentially zero, and they wanted to make some money on the money. They were taking in, billions of dollars, and they wanted to make some money on the money. So you couldn't make any basis points on short-term cash, on overnight money, because there was nothing there. So they laddered it out to where they could make 20, 30, 40 basis points. In the process of doing that, they ended up short the yield curve, and they just got, it was a horrible strategic move. And it's, Silicon Valley Bank was not a hedge fund, but they traded as if they were a hedge fund. And when people put money in demand deposits, they did not ask that bank to take risk for them. They asked that bank to hold their money. It's inexcusable. It's almost criminal what they did. And so hopefully they'll be prosecuted. And I think what they did was criminal.
Criminal. Wow, that's what Joe Biden, President Biden said he would be. But that takes me to, I want your personal opinion and your personal view about the world. A lot of people complain that When we asked for a single mother household, public option healthcare, public option, they said there is no money. When we say let's give some food money for food banks and this, we didn't have money. But when the banks fall in, immediately, boom, $300 billion available. So from as a human being and an entrepreneur like you, how do you feel about that? Like, I feel like I'm a rich person and doing well, but I came from a poor family and I was no. But when
first of all, it's not 300 million. Let's be fair. So Silicon Valley Bank, it's the Fed's job to stabilize the markets in a time of crisis. That's the Fed's main role. Whatever anybody thinks about what the Fed is supposed to do with respect to, setting rates, adjusting rates, the marketplace does that. The Fed's role is I believe the Fed's role is essentially to come in times of stress and in chaos, and to provide stabilization to the market so you protect the integrity of the banking system. Silicon Valley Bank, as dumb as they were, they lost $20 billion, basically. That's it. Their deposits were fine. They were just in long-term instruments, so they had, unrealized losses. And if rates go higher, they're going to have more unrealized losses. But Silicon Valley Bank, that money, their investors, their depositors were good. They were good depositors. There's no criminality there. And the money was invested in things that are all going to, they're going to mature, and then there's going to be 100% of principal back. So it's really just a $20 billion, it's just who's going to bail these people out in the interim. Somebody has to put up the money to pay off the depositors, which was necessary to protect the integrity of the system until somebody buys out the bank. Now that somebody's buying out the bank, they'll pay the government back. So the government basically, bailed out the losses, and what they'll do is they'll build that into the fees that the new bank, ends up paying for. There'll be an arb what the new bank ends up buying the assets for, and they'll make the money back. They'll just have to, wait for 10 years, but they'll make it back a couple extra basis points, and everybody will be happy, and the government actually probably won't lose anything on this trade. But it is their job to come in and stabilize. I don't think you can compare money that's used for one thing to something else. It bothers me when people say depositors should have lost their money, because in this situation, if that's the case, how's anybody supposed to ever deposit anything? You have to hold the bank's management team responsible for this entire debacle, because they blew it. And they did not act in good faith, and they did not act as the fiduciary they're supposed to be. If banks act in the fiduciary capacity, nobody should ever lose money for having faith in the U.S. banking system. If you're investing in a risk-free asset, you should not lose money. If you're investing in a risk asset, of course you should lose money if you're wrong. And these people were investing, though, in a risk-free asset. And that's you cannot ask somebody with let's say $1 billion to go to 400 different banks just to hit a minimum. I mean, it's not even possible. So we have to protect the banking system as it stands today. We have to protect the regional banks so people don't pull their money out. We have to protect just banking in general. And so I think that what the administration did was absolutely 100% right. People that don't think it was right, I just don't think they get it. The integrity of the system is too important. But we have to change the system, because it shouldn't break like that. And it's a very simple fix. You force banks to maintain short duration paper, and you force banks to mark everything to market. If they don't, they get fined. And that's it. And if you mark everything to market and you only can invest in short-term paper on demand deposits, what happened here would never happen. Then you can have FDIC insurance go from 250 to 10 million, because that makes total sense, because you're never going to have another bank problem. Then banks can be incompetent, but they still have to play by the rules. That's why brokerage firms never have any issues, because brokerage firms only use overnight paper. So there's never a question of integrity with respect to what are you doing with my customer funds. Now, you could have situations like in the crypto marketplace, like FTX, where you have a criminal like Sam Bankman-Fried who just steals the money. That's a different animal. That's pure fraud. That we have to protect against, but that's very difficult in a company that was not really regulated in the US.
Got it. No, when I said 100 millions, I meant for other banks, not necessarily in the United States, like Swiss Bank and
Yeah.
Republic in New York, I guess, another bank.
Yeah, yeah.
So
I mean, all those banks, listen, those situations with Signature Bank, Signature Bank and Silvergate were different situations. Those were crypto banks that did nothing wrong, but everybody freaked out about crypto firms, and so everybody pulled their money, which was crazy, but that was incredibly unfortunate. I think in the case of UBS, UBS was another bank that had an incompetent management team for many decades, and they had paper losses that were, they had unrealized losses that they were just not accounting for. And I think that, everybody finally, figured them out. They were basically, doing exactly the same thing that Silicon Valley Bank was doing in just even a bigger way. And they needed to be bailed out. And the Swiss government just, facilitated a transfer of power, a transfer of assets just to save the integrity of their banking system.
amazing, amazing. I want to take you to the Fed. So the Fed in 2020, COVID came, we put money a lot in the market, we lowered the rate to near zero. And then boom, we have inflation, supply chain problem, inflation, and then the war in Ukraine and things like that. From 0 to 100, how much you blame the Fed for the current inflation?
Okay. So I blame, I'm very opinionated on the Fed.
Please, the same here.
The Fed had a 10-year period from which they were reading their own press clippings, and they got politicized to a certain extent, and they had an opportunity to be proactive, but they missed it. And they got to the point where they pushed rates to a level that was unsustainable, and that's on them. They know better. And so the crisis that we're in, I mean, I shouldn't say crisis, but the inflationary period that we're in was a portion of it. I can't say it all because you remember, inflation is cyclical, and you're going to have inflation during different periods throughout history, no matter what. But I think in the case that we saw, the Fed they were so panic stricken by 2008, 2009 that they went so far in the other direction that they just didn't use, they weren't proactive enough to stop lowering rates and to realize that they had to normalize it. You basically couldn't go under, you had to normalize it. I think the Fed is now finally recognizing that they needed to raise rates at an accelerated pace to tame inflation. So I don't blame the Fed for the Silicon Valley or any of the banking issues, but I do blame the Fed for being relatively incompetent with respect to being proactive as far as interest rates go. Every single person in the world, everybody that's ever made a single trade, knows that at some point you've pushed it far enough. Like at some point, when you've taken rates down to zero, that is not sustainable.
Yes. And he put $3 trillion in 2020 when the economy was closed because health issue, not there is no economic activity. It's because health problem. People don't.
Yeah, I mean, I understand. Again, it's the same situation as the bank situation. It's a little bit different, but a pandemic was something incredibly new, and nobody really understood what a pandemic was or what that would mean. So I can understand the Fed not taking action in 2020 when the pandemic hit, because what they want to do at that point is, again, stabilize markets, protect the equity marketplace, stabilize the bond markets, do everything you have to do to keep everybody, the integrity of our market structure in place. But that was only a 35-day sell-off. When the market started to rally up in the second half of 2020, at that point, the Fed continued to put their foot on the gas pedal, lowering rates. At that point, they should have been flattening things out, not letting the yield curve get as inverted as it is. And basically, they could have at that point started to just say, hey, you know what? We're not going to lower any rates anymore. We've gone far enough, because this way we don't want to push ourselves into an inflationary period. They blew that.
The soft landing was not supposed to be in late 2020 or early 2021. The soft landing.
They blew it. They blew it. They
Yes.
were not proactive. They sat on their hands. They read their own press clippings too much.
Okay, excellent. That's great. That's so much about. Very thankful for this. I'll have a final two questions. The final one is the final last two is your recommendation for students. I have a students like 21, 22, and I have some students 27 or older even. Like, what's your recommendation? You have a unique history, a unique experience in world. What's your recommendation to our students?
Do you mean if I can give, are you asking me if I can give one piece of advice, what would it be?
Yeah, one piece of advice and career-wise, what good things for career to do?
Well, I'll answer both of those. For career-wise, I don't, obviously I don't care what anybody does. That's completely on them, what they choose to do career-wise. But I think the most important thing is everybody needs to learn how to differentiate yourself. Like every person's different. Don't worry about being the same as the person. Don't worry about being the same or better than the next person. Just be different on your own. And difference comes from, you can be different when you learn how to articulate subjects that you're really interested in. That's how you learn how to be different. When you're passionate about something and you learn how to articulate something, that will open doors for you. But you're never going to, at 22 or 23 or 25, you're never going to know actually what you're going to end up doing for the whole rest of your life. I mean, nobody knows that. But at least that puts you in a position to open some doors and to network. But my number one piece of advice for people, especially young people, and this is the mistake that I think that much of a generation makes, is every opportunity you have to take risk and I'm not talking about like jumping off the bridge that's behind you or something, I'm not talking about that. I'm talking about every opportunity you have to take, risk that you think is probabilistically or pot odds wise in your favor, take it. Like, most people are apprehensive about taking risk. And I think one of the things that we need to teach young people in this country or all over the world is just when you have an opportunity to take risk, take it. The people that make the most decisions in the favor of taking risk are the most successful people in the world, period.
Excellent. That's amazing. I think I really agree with you. Take risk if you can, if there's opportunity, yes. That is pretty much what I have. And if you have one final thought you want to share it with us or anything you want to.
No, I think that was a great conversation and I'm very happy with it. I will just leave the door open for you anytime you want to come back and, and talk and do something with your class. I'm wide open.
Excellent. I will do that. So thank you so much, Tom. I wanted to stay in the Zoom. I want to stop recording, but thank you so much. Stay in the Zoom.